I think the flash crash sent a clear message that there's something wrong in our system.
We continue to invent things faster than the regulators can understand it.
We have new technology. It's being harnessed in ways that no regulator will think about.
They are trying to recreate electronically what humans used to do on the old floor.
This is something Einstein would have had a field day with. This and, nuclear testing.
It's all done on, clicks and algorithms.
We deal with a market that is so information intensive right now, that the ability to process that information differentiates the winners from the losers.
That is a arms race. Okay, that's not what a stock market's all about.
Fast trading is fine, and faster trading is even better.
Too much complexity is not a good thing, and we're at the point where there's too much complexity.
This discussion is a little bit more intricate.
It's changed the nature of risk, and you have to manage it differently.
The industry makes a tremendous amount of money creating these new types of products until it blows up the world.
Until we have regulators who really know what they're doing, chances are they'll do more harm than good.
When God wanted to tell the human race how to behave, it was sufficient to come out with 10 commandments. When Congress wanted to tell the financial services industry how to behave, it took 2,313 pages. There's something wrong with this approach.
$550 million against Goldman Sachs, $150 million against JP Morgan, $50 million here, $25 million here, $80 million there. You have to ask yourself, is this what regulation is about?
It is different than it was 25 years ago. It will be different 25 years from now. That's not a bad thing.
We're not stupid. I mean, my phone does have push buttons. I've adapted.
I buy 1,000 shares here, I sell 1,000 shares here, and I'm good for that quote. Not you try to buy 1,000 shares and you get 100 shares and it disappears. Where'd it go? Oh, he saw you coming. He has faster pipe. He canceled before you got there. That's not a market. That's a game.
There's a group of traders out there who simply aren't following the rules.
What is that? What kind of market is that?
It's really hard to, shut stuff off.
There's really nothing anybody can do to stop them if it goes haywire.
That's not a place where people want to be.
Companies who are lining up to leave our capital markets.
Just scared a lot of folks who are very, very smart.
startling changes in the structure of U.S. financial markets in recent years have created what many experts say is a major fault line running under the surface of our economy. Since May 2010, the capital markets have experienced a series of tremors that have shaken some of the most experienced, powerful, and informed participants in the financial system. These quakes are happening with increasing frequency, and many believe it's time to start asking why.
If you are a retail investor, don't touch the TV, but also don't touch your telephone and call your broker.
76 evens are trading here now, guys. 75 evens are trading.
The volatility in the market has been frightening.
And what is happening in Greece makes traders realize that their concerns spread around the globe very quickly.
You can see now that the Dow is down some 400 points. It's getting at one point down about 900.
Plunged to now 700 points.
Stocks plunged almost 10% in the space of just a few white-knuckle minutes, making this one of the largest single-day losses ever recorded.
Wow! Almost 1,000 points!
The selling began as traders watched violent protests over spending cuts in the streets of Athens.
We call this a capitulation!
The machine's obviously broke. The system broke now.
I mean, now, look at
big
it.
investigation.
But now it may possibly, but there should be an investigation because
We have a situation where we have a flash crash with everybody in the world watching, and we don't have the data to ever find out what it is. So job number one for us has to be that we begin to get the data we need in order to be able to give a contemporaneous analysis, not a 6-month later analysis, contemporaneous at the times it happens, maybe 24 hours, something like that.
I'll tell you what I fear most, and I think we're heading in towards a situation. The global climate now is ripe for a situation where there's a crisis.
Because of Greece or what?
It could be many things. It could be many black swans we don't even know about. But we'll head towards a long-term capital type crisis where you'll get margin calls and a massive deleveraging. And then what happens is everyone tries to sell at the same time, and the bids and the buyers that you see in the market now will disappear. They have no obligation to maintain orderly markets anymore. They'll just disappear. The price vacuum will start, and we're going to plunge down. And that's my big fear. When that'll happen, who knows? But it will get to that point.
A constituent missing in this whole argument are the corporations who list their stocks, the investor relations folks, the CFOs of these major companies. When their stocks crash intraday for 5% and then zip right back up, and they don't know why, and they start calling on the people in the office saying, why'd my stock just go down 5%? And everybody goes, well, I don't know. You know why you don't know? Because the market structure's all screwed up.
And so flash crash day comes along. We now have more market messages than this can handle. This overflows, tips over, causes a lot of systems out there to stop because they're getting bad input. First thing you do when you get bad input as a trader, you stop. You have to have a stable or a believable place where investors will believe the price is true. And by ignoring that, we got the flash crash.
Okay, it shouldn't happen that a stock trades at a penny per share. It should never happen, and it happened during the flash crash. It should never happen that a stock trades at $100,000 a share, but it happened.
We've seen what can happen, and we've also seen how poorly the SEC really understood what was going on in the markets. And by the way, I'm the guy who warned the SEC in writing 5 times that our markets were vulnerable to that kind of a technological disruption.
The different systems are so dependent on everything running perfectly. And what can happen when things don't run so perfectly.
Positions taken by a trader nicknamed the London Whale wiped out billions at JP Morgan.
JP Morgan announced the highest legal trading losses in history on its QT earnings.
The explanation of what the vehicle was for the loss at JP Morgan Chase made by the London Whale, at that it's a hedge. It's a hedge, but when you read about it, after all, I mean, I have an MBA from the Wharton School. It's hard for me to understand what it is that there's so many complex interactions.
On Facebook's first day of trading, NASDAQ computer systems overloaded, leaving investors unable to execute orders.
Now, the stock famously faltered in its first day of trading, plunged in its first week, causing hundreds of millions in collective losses for professional as well as retail investors.
Well, the cancellations were interfering with the process that NASDAQ needs to run to match up the opening trade. Usually it takes 3 milliseconds to do this because of the size of the offering and the interest. It took them 5.
Combined losses of the top 4 market makers could exceed $100 million, and that is more than NASDAQ sets aside to cover technical glitches.
I mean, it's a huge black eye. Greifeld yesterday said they were humbly embarrassed.
We've already seen numerous lawsuits filed, some class action.
Arguably, an exchange's most important purpose is to bring a new company to market, all right? And to do it, and God knows we need new IPOs. We need new companies to come to market, and God knows we need confidence to come back to the market in the wake of the flash crash and you know, the whale story and all of the hijinks on Wall Street and the mortgage mess and what have you. So here we are. We have this great IPO. It's been talked about for weeks and weeks and weeks leading up to the actual day.
Coming up to 11 o'clock, we saw really crazy prices printing. Like the bid was $4,000 and the offer was $25. And I'm like, are you nuts? Is somebody really wanting to pay $4,000 for Facebook, a share? You know, why would you put that in there? 11 o'clock comes and the exchange says we can't open it up. They don't say why, it's just we're gonna be delayed. We're gonna delay it to 11:05. So everybody's like, okay, good. It's a big opening jitters, whatever. 11:05 comes along, we get the same story. Can't open it up. No more new information, but we can't open it up. It's gonna be 11:10. Okay, this is interesting. 11:10. 11:10 comes along. We're having problems opening it up. It's gonna be 11:30. So they're giving themselves another 20 minutes to open this up. And we're all thinking, what is going on here? 11:29 and 52 seconds comes along. 8 seconds before do or die time, we absolutely have to open this up or we're gonna get big egg on our face. Do whatever you have to. At that moment in time, 8 seconds before they're supposed to open the last time, we don't see any more trades or quotes in any stock from that exchange. In SPY, Microsoft, Apple, across the board. It's like that exchange just went off the boards for 17 seconds. 17 seconds. Like, if you or I were conversing and I gave you 17 seconds of silence, it'd be pretty awkward, right?
When they opened the stock, there were all these orders in the queue where no one had any idea whether the orders they put in to buy were executed or canceled. The orders they put in to sell were executed or canceled, and they didn't find out till late in the day, and in some cases the next day or 2 days later.
These algos trade on milliseconds. So that was 17,000 milliseconds. 17 million microseconds in exchange speak, right? Forever. And it's pretty clear that amount of time is somebody restarted a major system.
There were 2 big problems with Facebook. One was the NASDAQ snafu, which is just another one of these great electronic computer glitches that have gone on that I think are poisoning the well of investor confidence.
What's interesting is when they came back online, Facebook opened up about a second after that. But at the same time, orders in all the stocks across the board disappeared. And that's because algorithms feed off of prices and they saw something wrong. What happened to this exchange? You never go dark for 17 seconds, something's wrong, pull out. And so for those moments in time, our exchange was very vulnerable to bad information. Bad news would have caused stocks to move much more rapidly during that period of time than normal. And that's because there was bad input in the system. The system's all connected and everything, as long as everything's running perfectly, everything's good. But once things start breaking down, the fastest ones will immediately pull out. And when you only have the fastest ones left, you get nothing all of a sudden.
You can never test for every single scenario. We have to assume that something will go wrong, and we have to be able to stop it very quickly because these computer systems amplify problems at light speed faster than human beings physically can react.
In August of 2012, computer trading software went haywire at Knight Capital, costing investors $440 million in half an hour.
We're getting flashes from Dow Jones regarding this strange stock trading that we've seen this morning. A software problem being investigated at Knight Capital. That's according to a source. Knight software problem seen driving erroneous stock trades.
Stocks were trading, way outside where they should have been trading.
We saw massive amounts of buy and sell orders come into the New York Stock Exchange for the morning.
So you had Radio Shack, for example, was trading in like the $2.50 range prior to this, and then shot up to, $3.50, $3.60. And on no news, there was no reason that it should have shot up that much. Other stocks went down. It just depended on whether the algorithm was, programmed to be buying or selling. And then as soon as, the algorithm stopped trading, well then, all the prices, fell back down.
I sent out a tweet at 9:38. We saw it right when the market opened. Within seconds, we knew something was wrong. SPY is one of those symbols that's always the most actively traded symbol all the time. On this day, SPY is like number 38. And it was like, something is wrong, definitely wrong. And we tweeted about it, dear NYSE, locate the halt button ASAP.
That caused a number of stocks to be halted. The market has now reopened, and while the broader indices didn't have any major gyrations, a number of individual stocks had rather serious moves.
It wasn't just Knight that was impacted by this, though, right? I mean, people don't necessarily know, oh, this is a crazy algorithm gone wild, I shouldn't trade. So people might have had, sell orders in saying, okay, if a stock falls by 5%, I'm just going to take my losses and go home. But, that shouldn't happen just off the back of some algo gone wild.
Knight Capital, led by highly respected industry luminary Tom Joyce, was seen as one of the most stable and robust trading firms in the industry.
So if we could find it, there's no excuse for them to not have seen this immediately. How can my firm, which has no money on the line whether Knight makes or loses $400 million, know about it before Knight does?
The fact that, it could happen to them, A, that's scary. B, now that they're not trading as they were, I think that puts the market in a more precarious position. So who's filling their role?
You're starting to lose confidence. Events like the Facebook IPO, the BATS IPO, the Knight algorithm problem, the flash crash, they're starting to happen more frequently. People are starting to get nervous. They read headlines. They're saying, what's going on? What are those, Wall Street guys doing over there?
I'm actually more worried about the market, the markets now than I was a few days ago. Not because, this event happened and that means it could happen again, but more that Knight was a trusted participant.
What happens is when the algos are all based on speed, you can't have them doing anything smart. And by smart, I mean like going out to the network and saying, hey, do I have enough capital in my account to trade this? Maybe losing $400 million in 30 minutes is too much.
What we've seen is, and it's very hard to know whether or not the number of algorithmic trading problems, computer systems problems is increasing, but certainly the magnitude is, and it's not doing any favors to investor confidence.
At the end of the day, people are investing in companies, and if you're buying a company at a good price, it's a long-term investment that still will stand the test of time. Short-term glitches in the market, I think we have to look at it, perhaps slow things down. The advent of electronic trading, maybe we get a little more human interest, but humans can make mistakes as well. So, maybe some kind of slight slowing down market, but that's going to take a long time to get through the regulators.
There are growing signs of a far more devastating seismic event for the stock market in the near future. Chances are it will have nothing to do with a lack of entrepreneurial ideas in America or the fundamental performance of the stocks involved. Experts believe it will be structural.
I think we have to face up to the fact that we have some very serious problems generating from Wall Street. I think we have a number of indications that these problems are serious. I still know what would happen in this country if we had another meltdown, or if the high-frequency traders went off the tracks and we had a gigantic flash crash. What would happen to the country at that time, and then what it would mean for our children and our grandchildren.
I don't have a particular axe to grind about people trading rapidly. What I do have a grind about, however, is trading in a way that jeopardizes the stability of our markets for everyone else.
sudden market seizure could be systemic and possibly irreversible.
It's going to come back up again. There's going to be another flash crash. There'll be another rogue algo coming through. And then what happens? So rather than just, look the other way, let's address the issues. Let's look at what's going on here. And maybe it's time for a little bit of a do-over.
The stage for that stock market do-over is a scene commonly imagined. Wall Street, the New York Stock Exchange, floor traders and brokers trading face-to-face, hustling and shouting over the din, communicating with hand signals in a frenzy of buying and selling. This iconic district in Lower Manhattan, where tourists flock to stand on hallowed ground and catch a glimpse of the heart of capitalism and the nexus of today's U.S. financial markets. There's just one thing. They're standing on the wrong side of the river. The occupiers spent a lot of energy yelling at buildings that have long been converted to condos. Today's financial market reality is somewhat less romantic and a lot more quiet.
I think it's very easy, right? You turn on your TV every day, and it's easy to think that stocks traded the exact same way they did 30 or even 130 years ago, right? Those old exchanges have effectively turned into big media studios, and so business news is reported from them, and it makes it very easy for you to think, wow, stocks still trade in that same place the same way, when in fact a very, very small minority of the trading actually occurs at those locations.
If you went back 15 years ago, you'd go onto a Wall Street trading floor and you'd hear a roar of people screaming and yelling and talking, and now all of a sudden you go onto a trading floor and you can hear a pin drop. It's really rather remarkable how different it is.
Well, I think most people don't realize that New Jersey really is the new Wall Street, that almost all of the stock trading in the United States every single day happens within the borders of the state of New Jersey. Whether it's the physical offices like here at Direct Edge or the big data centers where all the computer systems are housed, every major stock exchange has their primary facility in New Jersey. So there are towns like Secaucus, Carteret, Mahwah, that really is the nerve center of the New York stock market. And the places that people are used to thinking of as the home of the stock market are really just glorified TV studios.
Direct Edge is not a household name, but the Jersey City-based stock exchange trades between 1 and 2 billion shares daily. That means on any given trading day, Direct Edge is ranked as the 3rd or 4th largest stock market in the United States.
Well, some people would say we have too many stock exchanges in this country, but I ask, do we have too many gas stations? Do we have too many supermarkets? Do we have too much competition? Competition improves the breed. It forces the exchanges to respond to the customers. It forces them to provide the best quality of service they possibly can. So I basically believe we should let competition play out.
This challenger to the New York Stock Exchange and NASDAQ is led by 40-year-old Bill O'Brien, Ivy League-educated financial markets wizard. Already a veteran of Goldman Sachs and NASDAQ, he took this new stock exchange from trading 300 million shares a day to 2 billion shares a day in just 18 months. The same evolution for the New York Stock Exchange happened over the 9 years between 1992 and 2001. The way America trades has changed, and that's just the tip of the iceberg.
The legacy exchanges have very, very powerful brands. They're household names. Firms like Direct Edge, which are one of the biggest stock exchanges in the world, are not known to very, very many people.
What's now left in Lower Manhattan is a museum to stock exchange nostalgia. After all, the neoclassical heritage classified building housing the New York Stock Exchange since 1903 is a lot more comforting an image than a warehouse in suburban New Jersey.
Let's take a step back, first of all. When you look at the U.S. markets, it's not just the New York Stock Exchange and NASDAQ. First of all, there are 13 regulated exchanges. And even New York and NASDAQ and BATS and Direct Edge have multiple markets.
The impact of increased competition has been substantial.
Well, costs have come way, way down. I mean, literally, they've been reduced by more than 99%. When you think about that from an institutional investor's perspective, 10 or 15 years ago, they may have paid 6 cents a share to execute an order on behalf of a mutual fund or an exchange-traded fund. Today, they're typically paying 1/10 of a cent, in some cases less. Now, for the individual investor, right, their commissions this time 10 or 15 years ago would have been hundreds of dollars to execute a trade in 100 shares of Apple or 100 shares of Walt Disney. Now they're doing it for $9.95, $8.95, $7.95, and they can do that from their iPhone or other mobile device from anywhere on the planet in a second or less. That couldn't have happened without the competition, not only among brokers, but among exchanges as well.
Gus Sauter is an investing heavyweight who oversees $1.6 trillion in assets on a daily basis. The much-lauded outgoing chief investment officer of the Vanguard Group has enjoyed a distinguished career at the firm, spanning 25 years. Under his leadership, Vanguard has emerged as a world-class investment firm. Recognizing cost efficiencies has had a lot to do with it.
So the good news is the markets have evolved quite dramatically over the last 15 years, and we've seen transaction costs plummet to about 1/3 what they were. So it's remarkable savings that investors have gained from just the reduction in transaction costs, and that's the result of many changes in the structure of the market itself.
I can't afford massive computers co-located in stock exchange data centers. The brokerage firms and mutual funds that I depend on can. And part of what I pay them to do is to use the appropriate technology to get the best execution from me.
If you go back 25 years ago, there were essentially 3 exchanges to trade on, the New York Stock Exchange, the American Stock Exchange, and NASDAQ. And each stock would trade on one of those 3 exchanges, and you would be somewhat of a hostage of wherever it happened to trade. Over time, we've seen the development of additional exchanges, and now there are more than 40 different venues to trade on. So you could buy IBM on the New York Stock Exchange or any one of 40-plus different venues. It turns out that that's led to a lot of changes in the marketplace itself, a lot of electronic trading, a lot of automatic, computerized type of trading, which actually, in our view, has brought costs down over time. At the same time, it does present some dangers. High-frequency trading is kind of a bad word or bad phrase nowadays, but actually many high-frequency traders are performing a very useful function of connecting the markets back together again. I should note that the term high-frequency trading covers many different types of strategies. It's not one strategy. Many of those strategies are, in our view, very beneficial for the marketplace.
So you don't have to outlaw high-frequency trading. It serves some very useful economic purposes. But you do have to enforce the rules that are already on the books. You don't need new rules for this.
Electronic trading is what brought down costs, but high-frequency trading brought down ethics. And in electronic trading has improved the spreads. It has made everything a lot less expensive. But in recent years, it's been a law of diminishing returns. It really, for us at least, comes down to following the rules. There's a group of traders out there who simply aren't following the rules. They're skirting the rules, and they're getting away with it because regulators are so mired up in the microseconds and high technology, they can't see the forest for the trees.
I don't think we've solved the trading problem yet. If you're a big institution and you want to trade a large block of stock on behalf of your beneficiaries, that's a hard job. If you dump the entire block in the lit public market all at once, that's going to scare people away, and you're going to get a bad price. So what can you do? Well, you can slice the order up into a lot of little pieces and drip them into the public market.
We're very aggressive, placing limit orders on all of our trades, breaking up the trades into appropriate sized pieces to trade. If we have a couple of million shares to trade, very difficult to do that in one lump sum. We might have to trade it in 100-share lots, 100 shares at a time. So it's very intensive process, but that's how you really minimize transaction costs. That's how you avoid some of the potential pitfalls of electronic trading, and we've seen our transaction costs plummet because of that.
The scope and gravity of those pitfalls presented by electronic trading depends on the position you occupy in the financial market ecosystem. In the cautious hands of Gus Sauter, computerized trading has delivered for Vanguard's strategy. But it's not working for everyone.
It used to be that these trades were done by human beings. Now it's reached the point where something over 60% of all the trades are done by high-frequency trading.
Well, first of all, you wouldn't believe it, and even academics simply just didn't believe a lot of the things like that we talk about are going on until they actually see the data. You just had Jim Angel on here, and he came to my office, and I printed him out 1 second of Disney, which was, I think it was 30,000 different price changes in 1 second. It was a stack of paper about this thick, and I said, Jim, this is what I want to talk to you about today. And that was the first time he ever really saw this, and he came to the same conclusion that any normal, sane person would, is what the hell is this?
Professional trading firms, investment banks, and the largest players in the industry have invested millions to develop the fastest, smartest, artificial intelligence black boxes that can trade more effectively, more efficiently, and at a speed that no human could ever execute manually.
What happened when we turned to high-frequency trading is we developed a group of people who used algorithms that would determine when is the best time to buy and when is the best time to sell. And you can make money just by making a very small bid on each one of those trades.
But there is a difference between using technology to execute a trading strategy efficiently and setting loose an algorithm to trade virtually on its own. In other words, computer programs can decide what security to trade, at what price, how many, and when, based on reading data feeds from the exchanges. Trading software can synthesize any type of information that can be read electronically and calculate its likely effect on stock prices, from a press release about a new patent to detecting popular search trends on Google. These programs send out orders across the market venues in a way that generates maximum profit for the trader. All this is done in the time it takes a human to blink.
There's an old saying from the United States Senator, he said, if it looks like a duck, it walks like a duck, and talks like a duck, it's a duck. These things look awful lot like gambles. This looks very much like a casino. When you have trading, high-frequency trading, thousands of trades in a second, and then you have 90% of the trades of the offers being withdrawn, canceled. 90% sounds like a casino to me. Again, I don't know. What we need the data to find out what's going on.
The vernacular of modern financial markets itself sounds like a sinister science fiction landscape.
Algorithmic trading, dark pools, and tick sizes. Now, let's start with tick sizes. Tick size is the smallest increment in which a stock trades. We used to trade stocks in quarter-point increments, and now we trade them in pennies or tenths of pennies or hundredths of pennies. And when you increase the level of complexity in trading by proliferating the number of price points, you go from 4 to $1 down to, as many as 1,000 to $1. The only way you can manage that level of complexity is through computers, and that all of a sudden creates an avalanche of interest in algorithmic and computerized trading to contend with the complexity.
Today, it's estimated that between 50 and 75% of trades on the U.S. market are not touched by a human, but driven by computer algorithms, performing digitized handshakes between lightning-fast machines.
Like when Disney's changing 20,000 times in a second, well, my question is, well, which one of those 20,000 are you picking? And then why are we having this discussion, right? Let's say Disney's selling for $50. The price change might be a bid for $49.99, $49.98, $97, $96, $95, $94, all the way down to $40, and then back up again.
And then we start to create all sorts of ways to get an edge up on trading, and some of those are what we call latency arbitrage, which means I'm going to get in front of your water before you can, right? In other words, that you're slower than I am, I see what you're doing, boom, I'm going to just step in front of your water. That undermines investor confidence. And I think that anybody that's traded a stock has seen, you try and buy a stock at $10 a share, and all of a sudden you see an order step in front of you at 10.01, this kind of cat and mouse that goes on. So what that then in turn does is it causes institutional investors who are concerned about information leakage because they have large orders to get done. They don't want people stepping in front of them. They move into dark pools.
When we're trading something, within fractions of a second, we can rifle through all of these various exchanges looking for the best execution for our stock. And sometimes it happens to reside inside one of these so-called dark pools where, again, you don't know what's being offered or bid inside the dark pool. But if you wander in there and you happen to find a great price, you take the execution.
To the uninitiated, a dark pool is the rather theatrical name given to a trading network established away from public exchanges, where trades can be executed anonymously, both in terms of size and trader identity. These networks enable institutional investors to buy or sell large blocks of securities without showing their hand to others. This stops others from working out their strategy and getting a free ride. In this way, large blocks of shares are traded with the prices being revealed to the public only after the order has been fully executed. While private trading is not exactly a new concept, these opaque trading venues have been widely criticized for their lack of public scrutiny, and possibly because dark pools have increasingly been taking market share in terms of trading volume away from the traditional lit exchanges, such as the New York Stock Exchange and NASDAQ.
NYSE Euronext Executive Vice President Thomas Callahan is calling for more oversight of dark pools today in written testimony to Congress.
Now, the middle of summer and the trading is light, or is it? What about trading that takes place off of exchanges?
Our entire business is about dark pools. It's a terrible misnomer, terrible name. We provide a very good service, as the SEC has just pointed out. When you trade 1 million shares or something, you need very different tools than if you're going to trade 100 shares or something. Anybody that's taken any economics would know that if somebody put 1 million shares of demand when there's only 1,000 shares of supply, for everyone to see, everyone knows where that price is going to go. And ultimately, that is a huge disadvantage for all of the little guys that invest their money into those mutual funds. So because this industry has grown so large over a relatively short amount of time, it's innovations like LiquidNet that come in that actually protect the little guy because we allow the institution to be able to trade the way that they should trade. An individual, when they go in and buy and sell stock, they don't have to worry about information leakage. They don't have to worry about moving the market when they do so. And the same should be said for the institution that's managing their money as well.
There's always been the ability for larger players to trade in secret. Now that sounds really horrible, but the U.S. market has always been set up so that larger investors can trade with other larger investors out of the limelight, out of sight from everyone else. Because if everyone else saw that I'm trying to buy 1 million shares, they would jump in front of me and make me pay more. So there's not a whole lot nefarious about the concept. Now, how it gets implemented sometimes becomes a little questionable.
Dark pools can be a very effective way to minimize transaction costs, but then again, they're not all created equal as well. We certainly monitor the various dark pools, and we don't use them all. We use a lot of dark pools, but not all of them.
The lit pools, the exchanges, they have their members, and their members are wide and diverse. For us, LiquidNet, we are a broker-dealer, so we are very, very protective of our community and very selective of who comes into the community. So it's really about who else are you trading with. And prevention is the best source of stopping anything wrong from happening. So we make sure that only those institutions that have the same problem come into our pool. And we're like the country club managers. We make sure that everybody's having a good time and that the food is hot and the greens are swept, but that nobody's digging up the fourth hole. So we've asked about 20% of all of the members, and we call our customers members, all of our members who have actually signed up to leave the community because they did not act in a way that benefited everyone else in the community. I think we're pretty much the only brokerage firm that does that. But the integrity of the orders that are in the system are so important to not only us, but to the value to our members. Clearly, we're the exception.
Institutions have a very difficult time. When you're trying to accumulate large blocks of stock in a market that only wants to trade 100 shares at a time, it's very, very challenging. Everything needs to be broken up. Everything needs to be hidden. That's to a certain extent why there's so many of these dark pools around, because if the sophisticated investors see that every 3 seconds, there's another trade, they'll find that pattern, and then they'll start pricing you up. So you need to switch your strategies. You need to switch your timing. You need to kind of hide stuff.
To remain competitive in this realm of trading phantoms and systematized intelligence, the largest, most resource-rich financial institutions, Goldman Sachs, Citigroup, JP Morgan Chase, the two bigger to fail firms, invest heavily in proprietary trading algorithms. These are their black boxes. The investment powerhouses are courting the most brilliant engineering and mathematical minds of our time, looking for their next trading edge at the top schools with elite quantitative and financial engineering programs. What kind of quantitative genius does it take to create algorithms that can outtrade any human?
We have a veteran trader here to help us make sense of it. John Netto is the president of M3 Capital. And
John, which is the most important factor in today's oil market?
Wonderkin John Netto is a professional trader and author of numerous publications on technical trading methodologies, including the statistically thought-provoking Dynamically Delta Hedging Your Option Portfolio.
I saw the movie Wall Street when I was 12, and the final scene in the movie where Charlie Sheen's character is like doing the right thing, and he's causing Blue Sky Airlines to go on this big rally to get Gordon Gekko to have to force them to buy a bunch of stock before reversing the position, having it sell back down again. And just that maneuverability and watching that energy from the floor of the NYSE, it was like this seminal change in my life. Like, this is what I knew I wanted to do. From age 12, I read my first book on derivatives, studied the markets, and through high school continued providing liquidity for those wishing to prognosticate on the outcome of sports. Now, some people call that a bookie, but I was a liquidity provider during my adolescence. Over the last 9 years, I've been involved in all sorts of things, from trading the markets I wrote a book that was published by McGraw-Hill, traveling all over the country, speaking on this and other topics. I moved to Las Vegas, developed in-game wagering models, formed another company called Quantitative Sports Strategies, which breaks down and handicaps using a lot of the same mathematics that go into market making for options as well. In 2008, I was a market maker for the US Futures Exchange for their mini dollar DAX. And this is when I'd say my introduction to high-frequency trading began.
One could say that the image of the brash, confident Wall Street trader has been replaced by that of a math geek, crunching formulas that might enable his firm to trade smarter, faster, and more opportunistically wherever there is so much as a single cent of profit to be made on a trade, even if that stock is to be held for less than a microsecond.
The truth is that this stuff is all on the microsecond level. And everything is measured within microseconds. So trades happen so frequently that, if someone else does a trade a little bit before you, you're done. You're now trading on old news. So it's not really a question of being right. It's a question of being right faster. So it's not exactly gambling. It's more like furiously proving yourself.
My definition of high-frequency trading is the ability to execute a strategy at a velocity that would be unachievable if executed manually. Okay, at its most simplest, least common denominator level. So for me, without the use of technology, without the ability to innovate and incorporate and assimilate this technology, I wouldn't be able to run a number of my strategies. I'm the epitome of a global macro commodity trading advisor. Trade fixed income, currencies, equities, metals, energies. And it's from that prospect. I mean, global macro strategies have grown rather significantly. So the majority of my P&L, the majority of my revenue is derived from P&L created from trading the markets. That's how I pay most of my bills, is from trading my account.
Well, I worked as a quant at a hedge fund for 2 years, just in the middle of the credit crisis. What we were really doing was creating models that allowed us to take advantage of dumb people. We were just algorithmizing, we were turning into code something that we could predict dumb people would do that would give us a chance to skim money off of them.
Some argue this category of trading has little to do with investing, but is more akin to robo-trading, turn it on and stand back. Others say it's the natural evolution of free competition and innovation.
Well, I think that automation is something which has positively impacted the markets. We deal with a market that is so information intensive right now that the ability to process that information differentiates the winners from the losers.
Trading in particular has changed dramatically in the amount of time it takes to trade and the speed of trading. I think that fast trading is fine and faster trading is even better. I don't think you benefit by saying, we got to gear everything to the lowest common denominator. Basically, it makes everyone up their game, and I don't see anything wrong with that. So, what's the difference between a millisecond and whatever the next increment of a second is? We can't begin to imagine a millisecond anyway. So, what's it matter if we cut that in a tenth? There may be some firms that are not able to compete in a higher speed environment. They don't have the systems to do it. Well, that is what competition is about. We all have to raise our bar to meet competitive threats. And so the strong will survive, and perhaps others will fall by the wayside. But at the same time, we'll benefit by the additional services that the strong provide us.
After all, we operate in a free market system. Building a competitive advantage over other players is the name of the game in every other industry. It's the same in financial markets. Vast amounts of research and development and capital are expended to get an edge.
It is different than it was 25 years ago. It will be different 25 years from now. That's not a bad thing. Competition's not a bad thing. Technology's not a bad thing. It's about how we evolve how the market works, the protective mechanisms in it to help investors.
Well, one of the problems with the regulators is when they wrote the regulations back in 2006, 2007, the concept of the speed of light didn't play because it wasn't really thought about. So the language is all about information is instantaneous because the speed of light takes time and information takes time to travel. As the machines got faster and faster, the speed of light became more and more and more important. And finally, we got to the point of the speed of trading where the dominant factor and what determined whether something was delayed or not was the speed of light.
Countries like Singapore and Australia have taken steps to prevent speed and algorithmic advantages from embedding themselves within the market structure. The United States, however, does not have any regulation to say it's not perfectly legal to use any trading velocity advantage conceivable. Many think it's time we did.
If I know what happened ahead before you know what happened, and things are priced based on you knowing what happened, like being slower, then I can take advantage of that, and knowing the price is about to swing up, I'll just buy ahead of you and know that you are going to, trail along, and then I can sell it back to you and earn a small amount of money doing that.
If you want to have algorithms that automatically permit you to trade rapidly, my approach is that's fine, provided that any order that actually gets put in gets executed. You don't need a new rule, in my view, to understand that if somebody puts in orders to test the pricing, or worse, influence the pricing of the marketplace, we have a term for that, and that's manipulation.
We were inventing things like instruments and markets that only smart people could really take advantage of, and dumb people would enter feeling like, oh, there's money there, I must be able to get rich too. But there was just no chance in hell that that would ever happen. It made me just feel completely disgusted with the whole thing, and I left finance. But nobody understands the financial system. It's too complicated. So that's what we need to address. I mean, that's what we've talked about in my Occupy group. How do we legislate a simpler financial system, and what are the political barriers to that?
Fact, almost half of the trades on the New York Stock Exchange each day happen in a matter of milliseconds.
You can't go back, critics agree, but they also question whether smaller, low-tech players will enjoy the same advantage as the big boys like Goldman Sachs or Citadel.
There's a powerful lobbying effort by some of the existing exchanges that are losing business to some of the other growing exchanges that are using high-speed trading and offering rebates to increase revenue.
With so much apparent rapid change and fragility in our current capital market system, many ask whether or not the SEC and regulators are in control of the situation. But the job before regulators is not simple.
The difficulty is that when the private sector does come up with something new, the government has to do more than say, thumbs up, thumbs down. I like it, I don't like it, or maybe this is good, or maybe it's not.
What we need is a streamlined regulatory system. And it's not a question of more regulation or less regulation. I get upset when people start talking as if you could just sort of move the regulation thermostat from 68 degrees to 75 degrees. It doesn't work like that. What we really need is more intelligent regulation.
What's really needed are principles, not rules, but have an idea, an understanding of how we would like our markets to function. That seems to be missing. And so you have people looking, for example, at the fact that fractional costs for securities might be made more efficient if you went to decimalization. Now, on paper, that sounds like a very logical thing, and it may well be logical. What nobody really thought about and what people were surprised about was that decimalization has led to fragmentations of our markets, less liquidity, and all of that disserves what the fundamental purpose of markets are.
In fact, today's capital market structure is so far from simple, it's mind-bending, even for the experts.
Too much complexity is not a good thing, and we're at the point where there's too much complexity. And how do you rope them back in? And we are absolutely horrific at knowing how to put boundaries on things and rope them back in.
Does the average investor understand how complex it's come and the glue that's tying it together, this rapid arbitrage dance?
So let's do the life cycle of a trade. So I'm trading at Schwab or E-Trade or whatever. I put in my 100 shares.
Every day we write, we study, we research, we try to figure out more, we ask questions, we call the exchanges, we call different people. It's not easy to understand, and that's the problem, and the industry loves it that way. They love complex things.
If it's a market order, it's going to go to a wholesaler.
They want you to be confused so that you just throw up your hands and you say, I don't know, I'll just put my order in there, and whatever happens, it's only a penny.
They're going to either trade it in the market, or they're actually going to use that stream of retail order flow to bring in institutional order flow where they actually make money.
No, those pennies add up. Nickels and dimes make quarters, I was told once.
If that order doesn't get matched by that internalizer, they're going to put it into a dark pool. If that order doesn't match up with an institutional order, it's more than likely going to go to another dark pool.
But the problem is the foundation on which this structure is built is just flawed. It's built with all these embedded arbitrages, these embedded conflicts of interest.
In some cases, those dark pools send out messages to people and say, hey, look, guys, I got an order here. Come and get me.
You can't understand the markets any longer, and I've said I've spent my entire life in the market, and I don't understand the market in its totality.
And then if no one actually wants to buy this order, or no one wants to trade against this order, then it goes to the market.
People do not trust these markets, and they think there are groups of insiders who have a clue about all this, and the rest of us unwashed have no idea. That is very, very bad for our capital markets. markets.
If capital market structure seems complicated to explain, try regulating it.
When I came in as chairman, I had to check my shoes every day to see what I might have stepped in, because from the get-go, there were catastrophes occurring. The first was 9/11 in 2001, and we had to get the markets back up and running, which was no simple task. And that was followed by Enron, the demise of Arthur Anderson, and a whole variety of similar types of sort of catastrophic events affecting the regulation of our capital markets. Having watched what's happened since I left, I'm now sort of thinking that my tenure may have been a walk in the park compared to things that we've seen.
We need to worry about the regulation of the markets to make sure that we have appropriate regulation. And unfortunately, our regulators are mostly lawyers who really don't understand technology. Most of them don't understand trading. And if you've got a toothache, you go to a dentist, not a lawyer. Well, what we have is the equivalent of lawyers doing dental work on our markets. You know, we need to have a regulatory system of people who really understand markets.
Most of our regulators, not all, but most, tend to be lawyers. Lawyers are great. I'm not sure I'd want either of my two daughters to marry one, but lawyers are fine. But the difficulty you have with lawyers is they're unidimensional. And the real need is for somebody to be multidimensional. That's like me trying to tell you how to drive a car if I've never driven a car.
Sometimes we refer to the market as the Frankenstein market. If you created Frankenstein, are you going to jump up there and say it's time to dismantle him? Who was the creator here? And now partially it was the SEC, partially it was the industry. But Frankenstein's out there, and now nobody really knows what to do. So what they try to do is put a Band-Aid around Frankenstein's arm when it falls off, or put another bandage on his knee.
Mary Shapiro, as SEC chairman, was highly respected and regarded as an agent of change.
Chairman Shapiro, she was the number 2 at the NASD when I was the number 2 at NASDAQ. And I know her. She's a terrific public servant, and she's incredibly sincere. She really, believes in making markets better. The problem with that job at the SEC is you're the designated javelin catcher. And, Congress appropriates your budget, and people use you as sort of a political whipping post sometimes.
Mary Shapiro stepped down as chairman voluntarily in November 2012.
Since the SEC was founded in 1934, in current dollars, we've spent roughly $17 billion. That is less than investors' losses from one Bernie Madoff. We have been penny-wise and pound-foolish in how we have funded our regulators.
And if you look at the comment letters that come in from the lobbyists, you can have people on the far left that are, sometimes a little on the crazy and certainly self-interested side and don't fully understand markets, but carry a lot of weight and write big checks to congressmen. And on the other hand, you have, people on the far right of the Republican Party that can that can write big checks that are making tons of money through high-frequency trading or hedge funds or other things that are distorting the process.
Clearly, the financial crisis of 2008 demonstrated there were some serious problems in our regulatory structure. Unfortunately, all Congress did was give us a couple thousand pages of Band-Aids without fixing the fundamental flaws in our regulatory structure. We need regulators who fundamentally understand what they're doing, as opposed to politically appointed lawyers with a short-term gig who have to respond to political pressures.
I do think it's one of the toughest jobs in America, there's no question. The frustration that we all have is it doesn't move quicker. They've had all these burdens thrust upon them, now the Jobs Act, Dodd-Frank rulemaking, and so, there's a certain amount that you can get through the narrow head of a funnel, and so it's a tough process to manage at the same time that everybody is unhappy because the economy is not doing well.
When these experts say the economy is not doing well, they are including some critical statistics that don't seem to be making it to the evening news. Not yet.
There's a great propensity for many in the market to try and advocate why this market structure is terrific. And it's a little bit of, we're looking at individual trees in the forest as opposed to the aggregate, the forest overall. And the forest is, are investors more confident? And the answer is no. Is the economy growing? The answer is no. Are we doing anywhere near the number of IPOs that we did back in the decade of the 80s or the 90s? And the answer is no. Are our stock markets growing? The answer is no.
The number of U.S. public companies has dropped dramatically in the last 20 years. We now have roughly half as many public U.S. companies as we had 20 years ago. We've created a capital market where smaller companies just can't go public the way they used to.
I am a firm believer that individuals should have the opportunity to invest in companies and help them grow as well as gain some upside from that capital. That's increasingly being shut out for mid and small companies because either the market structure doesn't benefit them, there's no research, there's nobody covering them, there's not enough trading volume to bring the high frequency guys to make markets, so these stocks are ignored. And when their stocks are ignored, the companies basically say, well, my earnings are better than this. Why isn't my stock price performing?
The only real beneficiaries of the computers, of electronic trading, are the large capitalized stocks. The small cap stocks, you just get eaten alive if they know that there's a real buyer out there. It's like, hey, we got a sucker here. It's time to play the game. All the games come out, and I've heard this from people who are head of global trading at major firms, and they send me these examples. I'm trying to buy the stock. What happened here? And well, you showed your hand. You told them that you wanted to buy stock. What happened when you wanted to advertise? Look, there's a real buyer here. That's what the market is for, is to find a real seller and match the two. Now it's all about a game identifying who really wants to buy and try to step in front of them.
The lack of IPOs, that's a great example of what hurts our competitiveness in this country. Everyone around the world looked to the United States to list as the primary market. So Hong Kong is now the global leader in IPOs, to a large extent because of Chinese companies, but also to a large extent because they are much more regulatorily flexible in allowing those IPOs to happen.
20 years ago, the way that information was disseminated on Wall Street was that salesmen and sales traders and traders all got on the telephone and talked to their counterparts or talked to customers. And today, everything is being done through little black boxes, and so nobody gets on the phone to talk to each other about what's going on in the market any longer. Large cap stocks are on the radar screens of every institutional investor out there. They're in the indexes, and they're never going to slip between the cracks because you're going to have 500, 1,000 analysts that are following Intel at any point in time between buy side and sell side. But the typical small cap, micro cap, nano cap company is just starving for visibility and attention, and the market used to absolutely provide that through the speaking that went on the salesmanship, the calls, the outbound phone calls that would be made. Today, those outbound phone calls are just not getting done.
Singapore is a fantastic example where they have created a very welcoming environment for investors, for companies to come into their country. We too have to become much more competitive and welcoming for businesses, for investors, and for taxation. Otherwise, this is the start of, the long decline in the American dynasty.
And what we have is a market which is so incredibly complicated and so incredibly fast and so incredibly low cost at all levels that it has essentially unleashed a flesh-eating bacteria on the broader ecosystem required to support fundamental investing.
Not only has the number of new companies listing on U.S. exchanges plummeted in the last 2 decades, but investors seem to be losing confidence in U.S. capital markets altogether.
We have to change market structure. We have to make it less complicated. We have to put in fail-safe systems so that we don't poison the well of investor confidence.
Well, our capital markets depend on a reputation for integrity. And if investors think that they're not getting a fair deal, they're not going to invest. And if they don't invest, that means less capital for economic growth.
A market is very, very sensitive. And when you lose confidence in a market, you don't just get it back tomorrow. And it's very simple to see. Every week since the flash crash, almost every single week, billions of dollars come out of the market, out of domestic equity, U.S. equity funds. Over $300 billion since May of 2010 has come out of U.S. mutual funds investing in equities.
Intel went public in 1971, and it was an $8 million IPO. And the company missed delivery on its very first product out of the box. Disappointed investors. The stock got cut in half. So now you have a float of only $4 million. I mean, this thing is tiny. And in today's market, it would become a zombie stock. So at any rate, they made delivery of the product. The salesman had a big selling concession or commission incentive to get on the phone, and the rest is history. That stock today is one of the most important employers in the United States. I think in the United States, it employs about 80,000 people. How many Intels have we not planted in our public markets today? And we should be manufacturing on the order of 600 to 1,200 IPOs a year, and yet the average number of IPOs we're doing is only 128. That may represent upwards of 10 million jobs lost to the U.S. economy. I mean, it's a staggering number of jobs, and you have to think that what it would do if people saw a functioning IPO market to instill entrepreneurs with confidence that they could raise capital to get investors to invest in private companies, and the positive reinforcement that would occur to trigger growth in the U.S. economy. That's what's missing.
Despite a sprawling continuum of perspectives, there is a unifying opinion that our markets have somewhere between room for improvement and the need for an extreme makeover.
Yeah, it's really interesting, the market structure that has evolved today. I've got to admit, if we were creating a market structure from scratch, the one we have today is not the one we would create.
Basically I was comparing our market structure today to the meat industry with pink slime. There's plenty of scientists who will say there's actually nothing wrong with pink slime. It's a bad word. Maybe we want to call it whatever it was, tenderized meat protein. And I get it. What the public should have is they should know what they're eating.
We have a salmonella scare. All of a sudden, everybody's wondering, where are all those food inspectors that should have been there on the job checking to see that we didn't have salmonella in our chicken? We have an automobile problem where a car accelerates when you're not even putting your foot on the brake pedal. Everyone's there. Why have we not checked that out? Why have we not found out what's going on? We have an airplane crash. Everybody wants to know, where is the regulator? Why was it not checked out? Are we inspecting these things? It goes through our entire society. We have a society where we have to have regulation.
Nowadays, it's all done on clicks and algorithms and electronically, and it's done in hours, and it's really hard to shut stuff off. It's hard to lock the front door.
If every wound was only solely self-inflicted, you could solve this through accountability. But the fact is that what you do is going to have an impact on other people and going to have an impact on investor confidence as a whole. So I don't think it's an Orwellian framework to control our stock market, but a framework does need to be there to make sure that people are taking risks that make sense relative both to the short-term and long-term rewards.
The risk is that, we continue to invent things faster than the regulators can understand it. And faster than we have the ability to assess the risk of it. So what happens and what has happened is that the industry makes a tremendous amount of money creating these new types of products until it blows up the world.
You hear today people try to reduce the debate first to whether we need more regulation or less regulation. I think that's a canard. We don't need either more or less regulation. What we need is smarter regulation.
Competition is good, and we all agree. But when they're drilling a hole through the Pennsylvania mountains, so go from New York to Chicago to shave 3 milliseconds so that you can be faster than someone else to arbitrage one product versus another, well, that's a difference in investor class, okay? That's paying for rent on a superhighway that goes to the highest bidder.
You also hear people say it's a question of whether you believe in free markets or whether you believe in government control of markets. And again, I think that's a false choice.
If we don't fix our financial regulation, if we don't fix our capital markets, we're going to have more unemployment. Indeed, if you look at the numbers, U.S. public companies employ 2 million people less than they did 20 years ago. Those 2 million jobless people should be marching on 100 F Street saying, "Where's my job?" Thank you, SEC. Thank you, U.S. Congress.
It's all about politics at this point. Everybody knows it's corrupt. People in finance know it's corrupt, except for the psychopaths who refuse to admit anything.
Well, one of the things is the algorithms are always changing. And detecting algorithms, something new in the field, there's no way you could do that real time. It would be impossible because they change so often. So you're chasing a ghost, really. You're chasing something that cannot be caught.
So you have a buyer at 45 cents and a seller at 45 cents, and it doesn't trade. Why? Because these order types only kick in when the player can get a rebate or a kickback from the exchange. This is insane. Is that how supply and demand is supposed to work? Is that how our capital markets worked for 100 years? Absolutely not.
That is a arms race. Okay, that's not what a stock market's all about. But somewhere along the line, people think that they needed to shave a millisecond and that's going to help everyone. That's not competition, right? That is a distorted playing field that the regulators, can they step in? No, you can't stop a wire from being drilled through the mountains of Pennsylvania or a cable being laid from New York to London that's quicker than someone else. But you can do things to kind of discourage someone from wanting to get on that wire.
We've done a couple of things here. We've made the markets more opaque. We made them dramatically more complicated. And we've unleashed a set of behaviors that undermine investor confidence. And we've now stripped away the economic incentive to support capital formation and the economy. Other than that, Mrs. Lincoln, how was the play?
There is no end of suggestions from very smart people as to how we might improve the way our capital markets function.
The first rule should be do no harm. That should be the first thing.
We have to have all the information about each one of the offers to buy, offers to sell. We have to know when there's a transaction, who's involved in the transaction. We have to know when it takes place. We have to know who the agents are.
They don't have to get data real time. They don't have to hire the best of the best in Wall Street. All they have to do is make a way for academia to be able to analyze the data, which they do anyway, by the way, and be able to report anomalies that they find. And then the SEC just has to show that we are going to look at this, because all the work has been done, and go after the bad guys. And the other bad guys are going to go, well, we can't get away with this anymore, so we better stop.
And, for one thing, our regulators are mostly housed in a granite fortress hundreds of miles away from the center of our financial markets. We need to move the bulk of the SEC's operations to our financial capitals of New York and Chicago. There, they'll be much closer to the markets they're regulating, and they'll be able to draw from a labor pool of people who know how markets work. And in the current economic environment, it should be easy for them to hire lots of experienced people who know where the bones are buried.
They should be able to walk over to Goldman Sachs, Morgan Stanley, LiquidNet, sit down with us and meet with us. And that should be part of their daily routine. And they should go and they should understand the pits in Chicago.
I worry about jobs in this country, and I worry about there not being enough technology and innovation to go along with the regulation. When you look through the 2,200 pages of Dodd-Frank, there's a lot of question, and talking with compliance and talking with my colleagues here on the street, that creates more ambiguity. And one thing will bury markets, that's ambiguity buries markets.
Microsoft is not the same thing as Third National Bank of Tennessee. And sometimes in our market structure, we lay out the mandate that whether a stock trades 20 million shares a day or 20,000 shares a day, we have to treat it exactly the same way, which is why we've advocated for more flexibility, for more experimentation, so we can give that next generation of great American companies, or our current generation of great small American companies, a stock market that works for them, that works for their investors, and works for the economy.
I think it's important for our industry to continue to educate investors. There's a tendency to create product and try to lure investors into that product without the appropriate level of education. And I think it's really incumbent upon us to make sure that what we're creating does create value.
No one who has absolute freedom necessarily can exercise that freedom responsibly for everyone's interests. And one of the things that government does do is it provides what is hopefully a neutral source to say, you can have freedom up until the point when you affect the well-being of large numbers of other people. At that point, your freedom ceases and you have to conform your behavior.
I do think it would be good to regulate against lying. And I also think it would be good to regulate against just being an asshole. I'm not sure that's possible.
But it's not a popular public discussion. Financial market structure doesn't feature in presidential campaigns.
It requires people of goodwill to be willing to compromise.
Because I think the discussion is a sophisticated discussion. And unfortunately, our election process, and I'm not trying to say that our country's stupid or any country's stupid, but the nature of the news cycle is everyone likes sound bites. So they want to know I'm pro-job creation or I'm anti-government spending or regulation or waste. And this discussion is a little bit more intricate and requires a little bit more thinking. And most folks, there's no marginal benefit for them to have those discussions in public.
What is absolutely hard for me to believe is that after what we went through in this great meltdown, the amount of pain that was caused to so many Americans and to so many people around the world, that we're not really making the effort we should to reform the system, that we still have arguments on just the basic reform, and we still have people saying, we really don't need to reform, there's no problem here. It's just hard to believe. And when those people have the ability to hire literally legions of lobbyists and public relations people to make their point, it makes it very difficult in our society to deal with those things.
What is clear is that as participants in the United States economy, there is an obligation for everyone to make their opinion clear and their voice heard.
Anybody, and we wrote this in our book, anybody who has money invested in the stock market should know it, whether it's a 401k or it's a pension fund or whatever it is. You should know, and we compare it to the engine of a race car. If you were a race car driver, wouldn't you want to know how the engine operates? Well, this is the engine of the stock market. And if it's your money involved, don't you want to know at least how it operates so that you can then make a better informed decision?
And as a nation, as a democracy, there is more at stake than just stock prices and algorithms.
On any metric of health, the stock markets are not functioning well. And so I think that it's great to pass on cost savings, but at what hidden cost? And the hidden costs here are absolutely catastrophic. It's throwing people out of work. It's depressing the economy. People can't get jobs. We have 20% of America's children now living below the poverty line. Okay, 40% living in low income or lower. We have over 20 million people that are unemployed or underemployed. It's catastrophic. And so I think that the classic, there is no free lunch, what are stock markets supposed to do? And fundamentally, one of the things that they're supposed to do is to help get capital into businesses so that those businesses can grow and employ people. And that's the clear area that stock markets have been failing at.
We're going to lose in terms of new companies getting the money they need, capital they need at the time they need it, and two was where do our investors go to invest their money. This would be terrible, terrible blow to the United States. This would be a terrible blow to any country, but especially damaging for us because we've always been at the top and the place where people have come from all over the world, not just Americans, but come from all over the world to invest and to raise money. What happens to our government and our economy and our society if in fact we lose that? Nothing good.
It's possible if you can incorporate and bring in all aspects along the social status within this country. From the top 1% to the bottom 5%, it's not a case of you're over there and we're over here. It truly has to be a collaborative effort, not a contentious one. And the current environment is not one that suggests that that's going to happen anytime soon. We as traders and investors invest on perception. I trade perception, not reality. Now, in the long run, reality and fundamentals will ultimately play themselves out, but in terms of impacting the market in the short term, we have to create a better job and a better perception, and a more conducive perception that will allow innovation to foster and grow.
When is the next tsunami going to hit the market? I don't know, but it will happen because we can look at history and we can see long before computers, from time to time, the markets get overwhelmed with a tsunami of trading activity.
There are ways, however, to change the game. The future is not a given.
If I were a congressman, I would be asking some questions as to why these rules aren't being enforced, and why are you proposing new rules if you're not going to enforce these? That's what I think they should be doing.
And I actually think the SEC does a better job than most agencies in that regard. They typically are very, very open to input. They don't come at any problem with a preset agenda. They really want to talk to and hear from people. And that's what I would encourage people to do. If they have an opinion about an issue, they should share it. They should write to the SEC. They read those letters. They care about them.
You can't keep ignoring that law without sooner or later they're going to either have to enforce it or they're going to have to rescind it. And my hope is that that will come to fruition and they will start enforcing it. Or we'll have a good industry discussion on why that's a bad rule and how to replace it.
Do the regulators have too much on their plate? Do the politicians even understand what market structure is? Does it take a flash crash to wake up a senator somewhere? Unfortunately, it does. You gotta tell them what you believe. When the public speaks, they have to act.
And we've even had the regulator recently say, this is the law, you broke it, here's your fine. And all they need to do is say to the congressman, why is the SEC not enforcing the rules?
Well, I'm a little Pollyanna. I think everybody should go in and swear on the Holy Bible when they go and meet with the SEC that their views are in the best interests of the United States of America. And I think when they testify in Congress, they should be sworn in.